Hi, everyone. My name is Michael Wasyl here with DeerCreek, and today we're going to be talking about a really interesting business use case that we developed for the Stacks 2.0 blockchain involving invoice financing and more specifically, invoice factoring. At a high level, we're going to be looking at how Stacks 2.0 could facilitate a programmatic, decentralized invoice factoring business model. We're going to be looking at what invoice factoring is, what types of invoice factoring would be best for this business model, and after this presentation, we hope you've walked away with how this business model combined with Stacks 2.0 can enable a great bridge between DeFi and institutional finance, all secured by Bitcoin. A little bit about DeerCreek and our firm so we can get to know each other. We build businesses at the intersection of finance and technology. We are a consulting firm in the fintech and blockchain spaces, and we leverage more than 2 decades of combined experience in fintech, new venture, banking, and private equity. Our leadership is listed here. It's myself and my partner, Pelli Wang. Specifically, we met at Consensus, where we worked in the Consensus Capital and Token Foundry teams, and we left in 2019 to pursue bringing new products and business models to this space. So what type of invoice factoring are we talking about? Specifically, we're looking at the discounting model. And in that way, it's the selling of receivables to a third party at a discount in return for cash up front. We'll also be looking at this in terms of a spot market. So just buying one invoice, no baskets, no groups of invoices, just one single invoice to one single investor. Even so, the traditional market is quite complex. With many different steps, you have three parties that are involved. You have the seller of the invoice, you have the customer of that particular company, and you have the factor that is agreeing to finance. In this case, Factr agrees to advance up to 80% or more many times, and less, depends on the industry, but 80% is generally the average of the amount due. The customer then pays the factor as per their obligation, and the factor then rebates the remaining 20% less interest and fees to the company. This is a very manual process. There's a lot of complex terms, trust issues between them, especially if it's a new factor and a new company relationship. So we'll be going over some of those issues in a little bit. The market in general is quite large. We're talking a $3 trillion invoice financing market growing at around 7 to 14% compound annual growth rate. There's a lot of enterprises using this, probably more than 100,000. That's what we could find in our own research. The key markets that we've looked at specifically are Southeast Asia and Eastern Europe, because these markets don't have access to the type of credit that more developed markets do. So any market like that, including West Africa, LATAM, and many areas, they do not have access to this type of finance or credit that we have here in developed markets in the United States, for instance. So invoice financing and invoice factoring are really the only options for these small and medium-sized businesses. Now, the challenge that we alluded to before is primarily that it's a broken and very expensive system. At first, there's a relationship interruption. The factor tends to collect for the company. That can hurt the relationship, especially if payment is late and they're starting to harass the company. Also, just general issues that the buyer might not even know who the factor is, and they might not be aware of that relationship. That's very confusing. There's also daily or monthly, weekly rate changes that can be written into these contracts, complex repurchase terms, monthly minimums or customer limits, exclusivity terms, high fees, up to 2 to 5% monthly, all very hard for companies to keep track of, and it's very expensive for them. Origination fees, credit check fees, ACH and wire fees, other hidden fees, and a long time to funding. It could take days to weeks to get funded, especially if it's a new relationship. So the solution, we looked at several different options, but we thought that the Stacks 2.0 blockchain was really the best solution to build a programmatic invoice factoring system, or to suggest the building of a product like this. We want to ultimately create a new DeFi bridge that allows institutional finance access to predictable returns and higher yields, bridging to DeFi. That's a really key point because there's a lot of yield-starved traditional financial companies out there that would love access to these types of products. We also realize that there are 2 kind of mandatory areas that need to be built out in order for this to work, which would include an NFT and ID verification system or registry to know who owns that digitized invoice at any particular time, even if it's a spot market one-to-one with no secondary market. And that Clarity smart contracts should be used to control payouts and funding terms. And that is really important because there'll be some pretty complex financial logic based on what we're suggesting here. So on Stacks, we kind of foresee a factoring protocol that could mint NFTs linked to off-chain invoices and automate payouts based on ownership. So compared to the original model that we had gone over earlier, it's much simpler using Stacks. You still have to sell that invoice to an investor, but that once those terms are digitized, and the physical contract is linked off-chain to a file storage system like Gaia on Stacks 2.0, the protocol underpinning the product could control the payouts, the advance, the rebate, everything that you need to make sure that this would work and that the owner of the NFT receives the funds at the end. And then once the fees are paid, the NFT is burned. And we feel that this is a very flexible and efficient system compared to the original system. And the relationship is potentially between the seller and the buyer is potentially preserved. And that's really a big step, we think, in the right direction. We would suggest some sort of web app that could be built with the product so that the customer paying for these products or paying the invoice wouldn't have much of an experience change. They pay in USD. There's an exchange in the back end. It swaps USD to Stacks so that the individuals that are funding these invoices in STX are paid in STX. We think there's a lot less friction there in doing it that way. In this system, there can also be very, very clear contract terms that are automated. So it's a lot better than the original system. And as a result of all of this, the fee structures could be more honed per industry, more and a little bit better. So it wouldn't be as blanket as across all industries like many factors tend to do, especially if there's not a really great relationship. So the cost of risk can be worked out per market in a competitive way, which we find to be great. And this system might not have to rely on traditional credit, which is a big plus in emerging markets. And finally, there is a short time to funding compared to traditional system, which would be minutes as compared to days or weeks for the traditional system. And as it relates to Stacks 2.0 itself, we think it's the best blockchain to build on for this because there are already some really great built-in incentives, including using STX to fund invoices, which to me and to us provides multiple sources of yield. Not only do STX holders get yield for participating in the ecosystem in terms of Bitcoin back, but they also can get yield as far as just buying invoices and receiving interest payments or interest in addition to the obligation that they are going in for. As far as predictable smart contracts are concerned, Clarity is really a step above a lot of other blockchains. It's decidable, precise. There's going to be more unambiguous syntax or complex financial logic, which is really important for developers, I'd imagine, because you want to know what your contracts are going to do in these types of complex circumstances. And lastly, the Stacks dApps ecosystem is built out. There's a lot of dApps already built that would help in such a product, such as file storage on the network already. So that's a huge advantage. And finally, what to take away from this, Stacks provides a solid base for developing a product in the factoring space. We really want to see someone in the community like take this on and develop it. There's a multi-trillion-dollar opportunity for faster financing and better yields for institutional finance. There could be dynamic rates, transparent to all parties. There's programmatic contract terms, which is a huge advantage over the existing system, and more accurately priced risk for all parties. So this is a big step up. And finally, the basis of all of this is better yield opportunities, because that's the motivating factor for not only traditional finance, but Stacks holders. And that's the end of the presentation. We'll be available after the presentation for any questions, and hopefully we'll be able to make some of our use cases and more detailed documentation available for the community to review. We didn't get to cover everything. This is a short presentation, but we're happy to answer questions afterwards and have a more robust conversation. Thank you very much.